up, the subprime borrowers had to kind of readjust their mortgage terms. So lenders responded by tightening the credit standards. I mean, again, there is nothing like bad or scary about this, the tightening credit standards, right? They didn't have to, they actually, it was advisable to have higher credit standards to begin with, right? So as the number of defaults increased, it was harder and harder to get credit, obviously, right? But as you have fewer and fewer new entrants, new families buying homes, it was pushing the housing prices further and further down. So this is how like the bubble started to burst. So the stricter standards meant that fewer people could afford to purchase homes, and the increased rates of foreclosures caused the prices of houses to fall starting 2006. Larger mortgage payments and lower housing values increase made the whole problem worse. But you know, the crisis was still mainly contained within the United States, right? But then, as international banks started realizing how much they invested in those pieces of papers called mortgage-based securities, right, they started questioning the value of those securities, and that kind of created the problem of the freezing of the credit markets international. Because, you know, for day-to-day business of the banks or the companies or personal individual investors, institutional investments, we rely a lot on credit, right? Once the banks stop giving you credits or increase the interest rates dramatically, this is where the economic activity stops, right? Because money, after all, is like blood in the blood in the body of the world economy. So dramatic thinning of trade for the credit instrument. So from being a very liquid instrument, it's kind of like the market almost disappeared. So 2007, 3 investment funds stopped redemptions because they could not accurately calculate the values of those securities, because nobody could predict what's going to happen with the US mortgage markets. Called into question financial firms' values, and high leverage financial firms kind of like made things even worse. So what happened to the credit markets? Well, literally every major international banks had a lot of those mortgage-based securities on their balance sheet, right? All of them had it, right? Once uncertainty increased, why nobody could predict what's going to happen with the value of those securities, it became harder and harder for the banks to borrow from each other and lend money to each other. So this is what I'll explain what it is. This is such called TED spread. So in simple terms, well, this is the spread, the interest rates difference between the safest asset in the world, which would be United States government debt, and the interbank lending rate in London, actually the way around. This is the rate at which banks borrow money from each other and lend money to each other, minus the interest rates on the government debt, right? So historically, this number is around like, you know, like 10% or even a fraction of the percent. So we're talking about like, imagine like 2 banks in London, right? 2 banks in London, which been separate entities, but they've been there, you know, for maybe hundreds of years, right? They've been lending money to each other for hundreds of years. They're like best buddies. They're more like relatives, right? So if you borrow money from a relative, you lend to your relative, you don't want to charge too much, right? So historically, this interest rates at which interbanks like channel money to each other and how much they charge, it's around 1%. But then during the crisis, you see there was like tremendous increase to 5%. And this is not like a car loan rate. So 5%, this is almost like a catastrophic number. So it means it's something like, and this happens during the crisis. It's something that, you know, let's say your most beloved relative has to have a surgery and you have to pay money, right? And you know, you pretty much like sell everything and give it to your dying relative, right? And at the same time you say, wait a second, things are so bad for me that I'm gonna charge you 5% interest. This is pretty much, you know, charging 5% during like a family crisis. So that was a kind of very that means that banks could not lend to each other anymore, banks that have been knowing each other for a long period of time. Then there was the fall of major investment houses in the United States. So, it started from Bear Stearns, which was acquired by J.P. Morgan. Then, as the problem started to accumulate, there was a bailout of those mortgage houses, Freddie Mac and Fannie Mae, right? And bailouts sometimes are not like a good thing. But in this case, the U.S. government and the world didn't have any choice, right? They couldn't let those underlying institutions fall. And there was a bailout of this American international group, largely because of its size and interconnection with the financial industry. So that was the kind of car insurance company, right? You don't want to let it go. So there was a series of bailouts, and they had to come up with a lot of money. Like by now, it's, they pretty much, the bailout package is around $1 trillion, but this is not the end. They have to come up with more. And now, pretty much every government in the world had to come up with their rescue package. So I don't know exactly the numbers. I don't know exactly the numbers for Canada, right? But they can be substantial. They can be substantial. But if you just like name any country in the world, one way or another, they had to bail their major banks. So this is just the scale of bailout. So this is this huge American, huge company, right? Doesn't look so big on this like a general scale of things, but this is American International Group, right? So this is kind of like this car insurance company, which was insuring against the defaults, right? 85 billion. I mean, if you think like in terms of like, is it like a lot of money, not a lot of money? If you think, I always try to convert it to, the net worth of Bill Gates. He's worth around like 55, or Warren Buffett, 55 million. I mean, that's a lot of money, right? It's a lot of money, but that was only the beginning, right? That was only the beginning. Fannie Mae and Freddie Mac cost 200 billion, right? And again, initially people around the world were kind of like, they said, well, this is purely American problem, right? It's their money. Well, let me put it this way: like everyone in the world will have to chip in sooner or later to this type of bailouts. So originally they were done in the United States with the taxpayers' money, right? But now the bailouts are going to be more coordinated through the World Bank and the International Monetary Fund, right? And almost every country in the world chips in their resources. So it's going to be like tremendous burden on every taxpayer around the world, everywhere. So 200 billion, that's what it cost them to bail out Fannie Mae and Freddie Mac. Large UK bank, $215 billion, Northern Rock. So that was, it's a little bit like, it was from, this picture from the New York Times, a little bit outdated because the bailout package did go through. But altogether it's 700 billion. Now it really increased more like to $1 trillion, right? What's $1 trillion? Well, $1 trillion, I mean, it's almost 10% of United States gross domestic product, right? So this is UK GDP, this is United States GDP. So, it's really a lot of money, and there are lots of companies literally shut down from the market, and there was good reason why those companies existed for almost like 150 years, such as Lehman Brothers. So Fannie Mae nationalized, Freddie Mac, not all of them are nationalized. I mean, some of them collapsed. Lehman Brothers is gone, probably the oldest investment house in the world, or one of them. Merrill Lynch is taken over, AIG nationalized, Washington Mutual collapsed. So the list is getting really huge. And this list doesn't really, other than maybe a couple of British companies, British banks, it doesn't include the rest of the world. I mean, if you add Brazil, China, Russia, you've heard of Iceland, right? You've heard of Iceland, how they really, I mean, they pretty much, their currency collapsed. I mean, high rates of inflation. They were showing people standing in line, trying to get food. And Iceland, it's a developed economy, right? It's a small economy. There are 300